Hello and welcome to marketing91.com. Let's start with aggregate demand. Aggregate demand, AD, is the total amount of goods and services demanded in an economy. Aggregate demand spending determines output and income, which in turn determines spending. Aggregate demand price is the amount of total receipts which all the firms in an economy expect to receive from the sale of output produced by a given number of workers. It increases with an increase in the number of workers employed. Let's understand the aggregate demand function curve graphically. X-axis indicates various levels of employment. Y-axis indicates the expected sales proceeds. AD equals C plus I plus G plus X minus M curve indicates aggregate demand. As the level of employment rises from OQ to OQ1, the price rises from OP to OP1. Up to point B, the expected proceeds increase with rising employment levels. Beyond point B, employment levels rise, income rises. However, aggregate demand rises at a diminishing rate because people tend to spend smaller portions of the increased income. Aggregate demand in a two-sector economy consists of only households and firms. AD has only two components, AD for consumption goods and AD for investment goods, that is, AD equals C plus I. Consumption demand depends on income, which is denoted by the equation C is the function of Y. This relationship can also be stated as C equals C bar plus CY. C bar is constant and shows the minimum level of consumption when income is zero. Coefficient C indicates the marginal propensity to consume, that is, the increase in consumption per unit increase in income. Savings, S, is the part of income that is not spent on consumption and can be expressed as S equals Y minus C. Savings can be expressed as a function of income, that is, S is a function of Y, because savings is related to income and is negative at zero income. The amount of savings depends on the marginal propensity to save, or MPS, which can be expressed as MPS equals delta S divided by delta Y, where delta S is change in savings and delta Y is change in income. We can deduce that aggregate demand is equal to the total income spent on consumption and investment, where savings are assumed to be equal to investment, that is, Y equals AD equals C plus I. Restating the relationship between income, consumption and savings, we get Y equals C plus S. Because S is assumed to be equal to I, we get Y equals C plus I. A three-sector economy consists of households, firms and the government. The government spends money for purchasing goods and services, paying salaries and wages to its employees and providing economic and social infrastructure services. Tax revenue forms a major source of government income, which affects the consumption expenditure of people. Government expenditure is treated as autonomous, and the entire expenditure results in an increase in aggregate demand to that extent. The aggregate demand in a three-sector economy can be restated as AD equals C plus I plus G, where G is government expenditure. A four-sector economy consists of households, firms, government and foreign sector. All foreign transactions where money is received are treated as exports, or X, and all foreign transactions which lead to the outflow of money are treated as imports, or M. Exports less imports, or X minus M, result in net earnings from foreign trade, which is expressed as NX. When NX is positive, there is net inflow which results in an increase in AD. When NX is negative, the outflow is greater than inflow, leading to a decline in AD. AD in an open economy can be expressed as AD equals C plus I plus G plus NX. Aggregate supply price is the amount of total receipts which all the firms in an economy must expect to receive from the sale of output produced by a given number of workers. It increases with an increase in the number of workers employed. The aggregate supply function curve can be explained graphically. X-axis shows the level of employment and Y-axis shows the aggregate national output. O equals F into N bar, L, K bar and T bar. This equation defines the aggregate supply curve. As the level of employment rises from Q to Q1, the output increases from O to O1. Up to point S, every additional unit of labor has higher output at an increasing rate. Beyond point S, every additional unit of labor results in a less than proportionate increase in output. Moving on, the Keynesian theory of income determination was explained by Keynes' book in General Theory of Employment, Interest and Money in 1936. According to Keynes' theory, unemployment occurs because of the lack of aggregate demand. The equilibrium level of income and output in the economy depends on the aggregate demand. The equilibrium level of income is determined by the intersection of the AD and AS curves. Now let's understand equilibrium level of income in two-sector economy. In a two-sector economy, AD consists of consumption and investment, that is, AD equals C plus I. To explain graphically, the AD curve intercepts the y-axis above the point of origin at point, which explains that aggregate demand at this point comprises only of consumption, which is positive despite the income being zero. The AS curve shows the total amount of goods and services produced in the economy and is represented by the 45-degree line from the origin. If the economy moves on the 45-degree line, AD equals to AS. The economy is in equilibrium at point E, where the AD curve intersects the 45-degree line, and the corresponding equilibrium national income is represented by ON. Up to point E, AD is greater than AS. Beyond point E, AS is greater than AD because the society does not spend all the income in terms of consumption and investment. The economy cannot produce more goods and services unless aggregate demand comprising C plus I increases. Point E is the point of intersection of where the AD curve and the 45-degree line. This point is called the Keynesian cross. Given the aggregate supply, an increase in equilibrium income can be attained only by increasing aggregate demand. In a three-sector economy, aggregate demand can be expressed as AD equals C plus I plus G. To explain graphically, the x-axis represents national income and y-axis represents aggregate demand. The intercept A bar shows the level of government expenditure. The slope of line AD1 indicates the marginal propensity of autonomous spending. The inclusion of government expenditure in the aggregate demand shifts the AD curve upwards to AD1. The equilibrium point shifts from E to E1 and the national income increases from ON to ON1 and increase to the extent of NN1. In case of a four-sector economy, the aggregate demand in an open economy can be expressed as AD equals C plus I plus G plus NX. To explain graphically, here there are two aggregate demand curves AD and AD1. When the economy is open to international transactions, we have a new demand curve AD1. The upward shift of the demand curve is based on the assumption that NX is positive. If NX is negative, AD1 will shift downwards. The new AD curve intersects the 45-degree line at point E1 and the income rises to ON, an increase represented by distance NN1. Given the aggregate supply, the level of national income depends on aggregate demand. Equilibrium is achieved at the intersection of the AD and AS curves and is called the Keynesian cross. The level of national income varies with changes in the AD curve. An upward shift in the AD curve increases the national income and vice versa. Thank you.